You're sitting across from a banker or filling out an online application. Everything feels normal. Name, address, date of birth, standard stuff. Then you hit the question, annual income, and without thinking, you type it in. Because of course you do. Everyone does. But here's the uncomfortable part. Nobody tells you that single number you just gave them quietly changed how expensive your financial life is about to become. Not maybe, not sometimes, almost always, and most people never even realize it happened. My name is Nico, and I spend way too much time thinking about how financial systems actually make money off normal people. If you're someone who works hard, earns a decent income, but somehow still feels like money disappears faster than it should, hit subscribe and give this video a thumbs up. Here's the thing. Banks don't ask for your salary just to verify eligibility. That's the story. That's the polite explanation. The real reason is pricing psychology. Now look, banks are businesses, and businesses don't charge based on fairness. They charge based on what you're willing and able to pay, and your salary tells them exactly that. Here's what most people don't realize. Modern banking isn't just risk assessment anymore. It's behavioral pricing. Let me explain. Imagine two people applying for the exact same credit card, same credit score, same payment history, same debt level. One earns $45,000 a year, the other earns $120,000. Who do you think gets offered the higher credit limit? Obviously the higher earner. And most people think that's a reward. It's not. It's an exposure strategy. Because statistically, higher credit limits lead to higher spending, and higher spending leads to higher interest revenue. According to Federal Reserve consumer credit data, revolving credit balances consistently rise alongside income growth, not because people suddenly become irresponsible, but because available credit quietly resets what feels normal to spend. This is where it gets interesting. Your salary doesn't just affect approval, it affects temptation. If someone earning $45,000 gets a $3,000 limit, they psychologically treat purchases differently than someone earning $120,000 with a $20,000 limit. Same brain, different environment. And environment drives behavior more than discipline ever will. Now you might be thinking, okay, Nick, but they need income to know I can repay the loan. Yes, partially. Risk assessment is real, but here's the twist. Once you pass a minimum repayment threshold, income becomes less about safety and more about optimization for the bank. Because banks don't make the most money from people who default, they make the most money from people who almost pay everything off, but carry balances sometimes. The financially stable customer is the perfect customer. Reliable, predictable, profitable. Let's run some simple math. Say you earn $90,000 a year and receive a credit line of $15,000. You never plan to use it fully. Of course not. But life happens. Travel upgrade, emergency expense, new phone, furniture, maybe a vacation you feel you deserve because you work hard. Your balance averages $6,000 across the year at a 22% interest rate. That's about $1,320 annually in interest. Not catastrophic, not painful enough to panic, but over 10 years, that's over $13,000 transferred quietly from your future self to a bank, assuming balances never grow. And here's the psychological trap. You don't feel poor while it's happening because your salary supports the payments. This is why income disclosure becomes powerful data. It tells lenders how much friction you can tolerate before changing behavior. Here's what most people don't realize. Financial institutions model pain thresholds, not emotional pain. Payment tolerance. They estimate how large a payment can be before you feel stressed enough to stop borrowing, and salary is the shortcut variable. Now let's zoom out. Have you ever noticed how loan offers increase after raises? You finally get promoted, and suddenly, pre-approved auto loans, higher credit limits, premium cards, personal loan offers. It feels like recognition, but the system isn't rewarding success. It's expanding capacity, because psychologically, income increases create what economists call lifestyle anchoring. Your brain recalibrates upward almost immediately. A study from behavioral economists shows that happiness spikes briefly after income increases, but spending adjusts within months. The brain normalizes the new baseline fast. So when banks learn your salary, they're learning your future spending trajectory, not just your current affordability. This is where people accidentally make a huge mistake. They assume transparency equals advantage. But in pricing systems, information asymmetry matters. The more one side knows about the other, the more precisely they can optimize outcomes. And guess who has more analytics power? Not us. Now, I'm not saying you should lie on financial applications. That's illegal and genuinely risky. But here's the nuance nobody talks about. You should understand when income disclosure is required and when it's simply convenient for them. Because not every financial interaction legally requires your salary. Many account upgrades, credit limit increases, and marketing-driven applications ask for income voluntarily, not because regulations demand it, but because better data improves profit modeling. And most people overshare automatically. Here's a simple metaphor. Imagine walking into a car dealership and immediately telling the salesperson your exact monthly budget and maximum willingness to pay. Negotiation over. Game finished. You just removed uncertainty for the seller. Salary disclosure works similarly in many financial contexts. It narrows pricing experimentation. Now you might be thinking, okay, but I want higher limits and better rewards, and that's fair. But here's the surprising part. Higher limits don't primarily benefit disciplined users. They primarily benefit average behavior. Even people who pay cards off monthly spend more when limits increase. Multiple behavioral finance studies show spending rises simply because perceived financial safety expands. Your brain treats unused credit like available money, even when logically you know it isn't. This is why the real conversation isn't about banks being evil. It's about incentives. Their incentive is usage. Your incentive should be control. And those two goals don't naturally align. So what should you actually do? First, only provide income when legally required for underwriting. Things like mortgages or major loans where risk evaluation genuinely matters. Second, stop chasing credit limit increases as status symbols. A higher limit should serve a purpose, not ego. If your emergency fund is $5,000, you probably don't need a $30,000 spending ceiling. Third, create artificial constraints. Here's a trick that sounds small but works incredibly well. Voluntarily lower available credit or set internal spending caps unrelated to income growth. Because discipline scales poorly, but systems scale beautifully. If your income doubles, but your spending rules stay fixed, wealth begins compounding almost automatically, and this is the part nobody expects. The real financial advantage isn't earning more, it's preventing lifestyle expansion from matching your earning power. Banks study your income to predict your future behavior. You should study your behavior to protect your future income, because wealth isn't built from access to money, it's built from resistance to easy money. Here's the truth most finance videos skip. You don't lose financially in one big mistake. You lose through thousands of small optimizations working against you quietly for years. A slightly higher interest rate here, a slightly larger balance there, a slightly bigger purchase that feels justified because I make more now. And suddenly 10 years pass and you earned a great salary, but your net worth doesn't reflect it. Not because you failed, because the system understood your psychology better than you did. But once you see it, you can't unsee it. You start asking different questions. Not what can I afford, but what keeps me financially free. Not how much credit can I get, but how little do I actually need. And that shift, that tiny mental flip, is where real financial progress starts. Because the goal isn't to look qualified to lenders, it's to become independent from needing them. You don't need perfection. You don't need extreme frugality, and you definitely don't need to stop earning more money. You just need awareness. Awareness of how information shapes offers, how offers shape behavior, and how behavior shapes your entire financial future. The moment you stop treating salary as harmless information and start seeing it as leverage, you begin playing the game differently. And when you play differently long enough, something surprising happens. Money stops feeling tight, decisions feel calmer, and financial freedom stops looking like a lucky outcome and starts looking like a predictable result. I'll see you in the next one.